Hello, in this video, we will continue with the others item in the classified balance sheet, right? So this is the first video about the first look at the financial statement. So now we already mentioned about the assets. So we have the current assets and others non-current assets. Now we look at the liability. So we will discuss about the current liability. So what does it mean, the current liability? Current liability are obligations the company is to pay within the coming year or its operating cycle, which is longer. So, as we mentioned, what does it mean, the operating cycle? Operating cycle is the time from the time that the company buys the material equipment to produce the product and sell it and collect the money from their client, right? Okay, so what kind of the asset that we can consider as a current liability? So usually the list not payable first, right? So it means that the one that you bought the promissory you borrow from the bank in the short term, and after that you have the accounts payable. That's the amount that you the invoice that you have, the amount invoice that you have to pay for your pay for your supplier, because if you buy on the credit term or you buy the product on account. In the list of the current liability, other item follow in order of magnitude, right? So always notes payable, accounts payable, and other account other item that's follow this order, right? So the other the common example of the current liability can be considered as uh, accounts payable, salary and wages payable, right? So what does it, why we need to have a salaries and wage payable? Because we have to think about that when you work for the company, right? Normally they have a day to pay the, how to say, the salaries for the worker, right? So if you do the, how to say, the financial statement before that date is not the day to pay, but it means that the people work for you for a certain period of time, you have to pay for them. So we call is salaries and wage payable. Notes payable is the loan that you borrow in short term period, right? The interest payable, you have to pay the interest. The income taxes payable, and also the current maturity of long-term obligation, right? So it means that you have to, now you know that in the next month you have to pay for your some of the long-term debt, right? So the company will pay the debt within 1 year or the operating cycle, which is longer. So that it is a concept and some example of current liability. So now if we look at the company, the market corporation, we see the current liability here. They have a note payable, account payable, current maturity of long-term debt. It means that on this day they have to pay for the debt that on the debt to pay. And most also, so we call it the other current liabilities or income, the tax and salaries, the wages payable. So the total amount is 127,000 US dollar for the company market corporation. We look more about what does it mean, the notes payable. So the notes payable and what can be have as a name is a written promissory note, like this is a contract that you want to promise to the lender or the creditor for a short period of time, with the principal amount you have to pay and also the interest for how long, what's the period, right? So normally the notes payable, this is a paper that the borrower have to pay the interest for the amount that they borrow from the lender, right? So but with the, if we mention about the current liability, it means that this term of the lending is those due within 1 year of the balance sheet debt are usually classified as a current liability. So it means that less than 1 year, right? So called is a note payable. But however, we have to consider another current liability. We call this unearned service revenue or unearned revenue, right? So the revenues that are received before the company deliver goods or provides a service, right? For example, if the company like airline, they sell the air ticket for you, but you book the ticket airline before you paid to the customer to the airline, but the airline didn't perform the service, so they will so at the time you receive your money, we call is unearned revenue, and this can be considered as a current liability because the company have an obligation to perform their service in the certain day, right? So when the companies receive the unearned revenue by cash, so the company will debit cash, it means that the increase the cash, and credit a current liability account we call is unearned revenue, right? When the company earns the revenue, it means that when they perform the service, it debits the unearned revenue. It means that debit the same amount equal to zero, for example, and credits a revenue account. So it depends. So what kind of service? Normally for O10, for the magazine publisher, or sometimes you buy the, how to say, you buy the gift card, right, for the new year, for like the gift cash for the people. Okay. So I think that we stop our current liability, and in the next video we talk about the long-term liability.